experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, I'm going to discuss my expectations for the Fed. We'll talk about the market setup and what likely is going to unfold over the next couple of days. Let's get into tonight's video. Okay, folks, interesting session today. We kind of slopped around most of the day. At the very end of the day, we almost made a new high from Friday. We just came up short. I'll talk a little bit about this in a bit, but the potential is that we just completed and actually violated the 3-day trade that I always talk about. So I'll go through that here in a few minutes. So here's the plan while the room is starting to fill up. We may touch a little bit on the dollar. I think there's some interesting things going on there, but let's get into talking about the Fed. I notice there's the CME Fed Watch tool, whatever it's called. That thing is up to 60%, 62% probability of a decrease of 50 basis points. And I'm going to go through, that's not going to happen. And in fact, that predictive tool is probably the worst prediction tool ever developed by man. It's really just an emotional place for folks to place some bets on some things that are likely not going to happen. There's a couple of things that I think the Fed is up against, and doing 50 basis points, let's ask a couple questions that I think that why that's not going to happen, right? You would think it's interesting that this is being bid again by the we'll call it the tribe, the swarm, the stampede. You got a lot of folks out there thinking that somehow the Fed needs to do. They actually probably do need to lower 50 basis points based on where the long end of the curve is. And I'll go through that here in a little bit. But the bottom line is there's no economic reason to do it, right? We still have all the numbers are positive. Who knows if any number that we see anymore is actually true or accurate, all that. But based on what we're being told, this is exactly what is going on there. So let me just make sure I've got the mic set up here good. Anyway, so I don't see any of this happening. There's no basis for them, no pun intended, for them to lower the 50 points. There's no need. They're likely to do it 25, and I've been arguing, those of you that have my Substack, I've been arguing this for weeks that this is a window dressing. So I don't know, let me just check something. I'm looking at another screen here for a second and just see if I had posted this chart in here. I'm hoping I put this one chart in. I don't see it. Unfortunately, I did not put it in. But I think I have it up, so I'll pull it up here anyway. But the yield curve is pretty much, it's slightly lower than where it was earlier in the year from the standpoint, but the curve is about the same. So I think the Fed needs to adjust they're going to do a 25% of 0.25 basis points, right? They're going to drop it by that. It's going to be a window dressing move, meaning they want to show that they need to adjust these things, but they don't want to signal that something's wrong. I think 50 basis points says that they're panicking about something, and I don't think there's any reason for them to panic. You're actually seeing some uptick in real estate. We've seen the back end of the curve, come down, the 10-year down into the 350 handle, 3.5 range, upper range of that. And that's just, there's no reason, absolutely no reason. And for them to do that, it's also it hasn't happened very many times in in the past that they've dropped by 50 basis points. So the expectation of that is just kind of silly right now. If you go back in maybe 2008, you saw some crazy stuff going on, but look what was going on around. And of course, the pandemic, there was plenty of stuff going there where they were just dropping rates. But there's no actual practical reason to do that. And one thing I'm going to give Jay Powell a on is that he's been very consistent at staying the corporate line, so to speak, where they're going to walk this thing forward. My expectation is they might even skip a meeting and then start in December. Everything I'm seeing is December forward. I think there's about 150 basis points to drop on the front end, could be even a bit more. But I think to get there, that's going to carry us into probably, let's say, late Q2 of 2025, maybe early Q3, but the better part of a year from now to get to that level. And unless there's some economic event or something that's happening that we're not aware of right now, then there's not going to be any need to do that. And I don't think they're that concerned about it anyway. Like I said, we're already seeing slight uptick, stabilization. Real estate's been underwater for a little bit now. It's stabilizing. There's still a lot there that needs to happen from that standpoint. But so I don't see the reason for that to happen. Let me just see if I can bring something up on the other screen here while we're all hanging out. We're still getting the room filled up. Let's take a look at just bear with me a second while I get there. Let me go ahead and go on screen here and I'll show you this. This is actually a pretty good tool. I like this. It's US Treasury yieldcurve.com, and they do have a Patreon. But one of the things I like about this is they will let you set back the chart. So I'm going to set it back and show you what it looked like on December 31st. And so the red line is what it looked like at the beginning of this year. Okay. Now we look at the blue. That's where we are right now. So a little bit of difference on the back end of the curve, but especially at the 5 and the 2 range around that is starting to see where you're seeing this dip down. You can see if we go back here, I'm just roughly if you can see my cursor here, that is where the 2-year was at the beginning of the year. So it was slightly higher than the 10-year. And so that was the big inversion. Now everybody's going, it's not inverted anymore. Well, of course it is. Look at the chart here. The front end of the curve where the T-bills and the Fed funds are really important in understanding how the banking system works and where a lot of the financing is happening in that front end of the yield curve. You've got short-term CDs, all kinds of stuff that gets wrapped up into that 6-month, 1 year. Then you get into the 2 and 3 year period. So we're seeing that drop there. What we need to happen, and I've drawn this in before, what we need to happen is the front end of the yield curve is being held up artificially by the Fed right now. They're going to drop it to 5, and they're just going to keep down ticking 375, 350. I think we get it all the way down to the bottom of this chart, somewhere between 3.5 and 3%. Now that's 2.25. That's 225 basis points. I think that happens, but it's going to happen over time, very methodically. And unless, like I said, there's some event that happens and we don't know about that they need to move faster, I think they're going to do it very methodical. There's very few times that they've had to panic on any of this stuff. So let me see if my drawing tool is working. It is. So what I'm ultimately looking at is that this is what the rates will look like here. The blue line I drew from around 3% up to around 3.5 to 4.25. I still think the back end of the curve flattens, but as we go, I'm just going to draw in some different color line here. As we go forward, though, this is what the curve's going to gradually increment by increment moved like this. And you're just going to see almost like fan lines all the way down until we're almost flat. And then you'll start to see this blue line I drew down here below. That's what I think it's going to end up like, but it's just going to gradually put down. Now, this is going to be a lot of talk's going to happen. We get a quarter point decrease this week. A lot of talk is going to happen from that standpoint that the Fed is the pivot. I'm doing the air quotes here, and the pivot is really this. This was part of the plan. And those of you who've been around the channel for a while know really what I've been talking about for some time is a normalization of interest rates. So when they moved everything up, they what they wanted to see is where the back end of the market. This is where the financing, real financing happens 7, 10, and not a lot in the 30, but that 7, 10 area is a lot of financing happens in that zone in the economy. And this has been also my argument against the Russell. So I'll try just a general talk about this. But this here, what this whole fan line, this is what's likely going to happen from the standpoint of gradually adjusting. And ultimately, the reason why this is important is a typical healthy yield curve is where the front end of the curve is lower than the back end. And typically it's about 1 to 1.5% is a normalization. So I've been arguing for a normalization since they started raising rates. They originally raised to offset the inflation, which maybe you could say it worked. I don't see inflation sort of like utility bills. Once they raise them, they never go down. So they've just changing the rate. So we're still going to be inflating. 2% is what's acceptable from that standpoint. So bear with me if you hear my dog barking. I apologize. I am working from home right now. So anyway, the event, like I said, that is likely to happen is going to be just this normalization. And once the normalization is done, I believe that what Powell is going to do is he's going to let the dog wag the tail again, going all the way back to Helicopter Ben back in 2008. We've watched the Fed wag the tail. Otherwise, the tail's wagging the dog, right? So you've got all of this stuff being artificially done. They want the market to be back in control. Now, I'm an older guy. I was around in 1979 when Volcker came in, and I'm going to do a video. I'm still working on some research on it, and I'm going to do a video about why between 1951 and 1970, everything was very stable and a very strong growth period of the U.S. And then when it got unstable, when Arthur Burns came in and some of that stuff. I want to do more of a historical video on this because I think it has a lot of context, because I believe that the Powell wants to go back to that operation from that standpoint of how the Fed's going to operate. So this is an important fact to understand. Unfortunately, there's a lot of players. Like, you can be in the markets now for a better part of 15, 20 years, and you can be considered a veteran. The problem is you think the way the Fed's been operating for the last 15, 20 years is what's normal, and it's not. It's been the opposite of what's normal, meaning that the Fed is trying to micromanage everything going on. Like I said, I started in 1979. I was around, and when inflation was real at 25%, interest rates were 25%, and it took a long time even for that, going into the mid to late 80s, before we saw a stabilization and interest rates start to get down to a reasonable level. And actually, if you draw a line across history, you'll see around where we are now, around 6% is a really typical interest rate from a long-term financing standpoint. So I think all we're doing here, folks, is trying to get normalized and see where the market wants rates to be based on demand and all that. And that's what we've seen in back into the curve because real estate softened and we saw demand fall off. And now the Fed's just going to adjust. I think I sunk my putt. Uh, yeah, great. Yeah, he's a little Papillon. Yeah, he's an old dog, so he doesn't know. He thinks I'm not home. So anyway, thanks for the comment there. Yeah. So the Fed chair William Martin or William Mackenzie Martin, this guy was probably the best Federal Reserve ever, and I am going to do a video because I believe that, and I've talked about this, those of you who've been around for a while, I've been talking about how I heard something from Powell one day that he goes, we're starting a process that we believe long-term is going to be very positive for the markets. And I think it's really going back to this old methodology. And I would just say when in 1970, it might have been 71, but when William Martin left the Fed, that's where Arthur Burns, I've always, since I've been in the markets, claimed that Arthur Burns was the worst Fed chairman ever. That was before I knew Janet Yellen was going to be a Fed chair. But the bottom line is he started all the volatility. He started a new cycle of things, and it really got out of control, including the inflation triggers and all of this. So, anyway, we'll leave it at that because I'm going to save that for history. But as we go through this week, I just think we see a 25. I'll just summarize this because that's what I really wanted to talk about tonight. We get 0.25, no reason to do 0.50. If we get that, then that would, I think, send a bad signal. I said that earlier. But the bottom line is what we're likely to see here is really the markets are going to, every news story you're going to hear and the algorithms that everybody's going to be trading off the Fed pivot. And that's what we're seeing now. Just a real quick comment, then we'll go to the charts here. The good news is I've started this late enough tonight that we're going to be able to take a look at the database because it's run. And it's, once again, just amazing what's going on that stuff. But anyway, yeah, so let's matter of fact, let's just go ahead and get into the database. Let me bring up a couple things here that will set this up, and that'll be, let's go ahead, 1 second. So I'm going to ask you folks a question. Hopefully, if you get the Substack, I've just got the Substack up here right now. If you get this, I got totally carried away. I think it was 4,600 words. It was like 25 minutes to yeah, no, they're not going to truck me, Vetus. They're not doing it. Okay, so the markets. So here's the deal. On just real quick comment is that the Fed has. There's no reason to do 50. I think I made my point. Okay, so my question to you folks is, I want to bring up this chart here. I need to do some kind of survey or something, but I'll just ask those of you, if you get the Substack, is it too long? Is it too in detail? Just let me know what you think about it, because I go crazy writing this thing. I actually love writing, and it's very, very exciting to me. So I put up a chart that I generated. Now, this is kind of interesting because this chart came out of ChatGPT, but it came out of our WaveTech database. And I'm soon going to show you folks how to use a WaveTech tool and use it with ChatGPT because there's some crazy stats. So what I did was I asked Chat last night to draw me a graphic because I talk about the percent bullish, and I'm going to go to the database here in a minute. But I've been talking about how we've just continued to stay over this 65% on the intermediate. So this is the intermediate database. It also shows some, the bottom part of this chart shows the returns that are happening by sector. And we've been running on about 6 sectors all year. Now we're up to 8. So we're actually, believe it or not, getting more traction. And the database is at 75% bullish right now on an intermediate. And I'll show you the daily here with the update tonight. And I'll discuss this in the Substack tonight. But the bottom line is this is such a robust environment. It's unbelievable. And at the beginning of the year, people thought I was a little off because what we've been seeing over, if we look in the rearview mirror, we go to 22 was a bad year, let's say 21 good, 22 bad. That was the crash of all the meme stocks, all of that stuff that happened. And we get 23, we get a good market. 24 was supposed to be a bad market. They've been back and forth. And I proclaimed, because of the database, it was virtually 1 year ago, and I think the second week of October, we saw the database start to get a ton of traction, and it carried us into January. And in January, we were well over the 42% mark, and I started to proclaim that we're now hit a material traction on the database. So these are not, when I show you the database, they're trends being developed by the algorithm and the trading model that I built that's got basically 600 variables and about 60 rules. We run 10 million calculations every night. We have for decades. And so that when I tell you about the short-term database, there's a lot of rotation on a short term. It's pretty noisy, but it does give us some ideas about traction and short-term trends. This here that I have up on the screen right now that I had in Substack last night is actually going into the intermediate realm. And what we're seeing is a refreshing. So we got down to around 62% bullish, and now it's back at 75. We're seeing big traction on this. So let me go over here and show you this is the daily database. We were down to 47% a few days ago. We're now back up at 6410. And we're seeing there was 1,700 plus new entries for tomorrow's opening, and only 140 exits. We're now pushed it up to about 64.10 from that standpoint. So this is crazy because we're back above that 62. We typically get up to we'll say 68, 72 range on this database. Sometimes it'll get stronger. And the intermediate database, I've seen up over 90%. So this is interesting because we keep getting basically a retracement, what I call a rotation, and then we get more buys coming in and they keep rotating. And it's a very, very interesting from that standpoint, because I watched this database. First time it ran was 1998, and it's been evolving. Back in the old days, I believe we had about 5,800 or 6,400 symbols in a database. And the way that we built our database, we had an institutional environment, and you could just request data to add data in. And so everything was based on our user request. And then I believe now we're up at somewhere in the range of we're 14,975. So anyway, database is still getting more traction. One of the things I wanted to see here, we have no new buys, but we now have, on a short-term basis, we have 8 sectors. We also, I believe, I'm going to flip this over to the weekly. Weekly is also at 8, and it's at 76.04. So this is, I will tell you from my viewpoint, crazy. In our Portfolio Expert software, we actually have a portfolio that the decisions being made is hardly dominated by this percent bullish. And I don't think we've had we haven't had a trade in that thing for almost 2 years, and it just kind of keeps rolling. It's a group of 5 ETFs, so it's done pretty good. Yeah, so I know everybody's hung up on this 50 basis points, but no, not going to happen. There's no reason for it. Why do they need to stimulate a market that is trading less than 0.5% off the all-time highs? Think about it. Just think through that when you get your expectations. The biggest issue that we have as we go forward here is that the market's overpriced this thing, and then there's probably nothing. This is what I talked about. There's an old saying in the markets. It's called, buy the rumor, sell the fact. Otherwise, buy the rumor of what's going to happen, then you sell it when it does happen. And so, we'll go through that. Yeah, so it's interesting, William. I'd love, we are working on something, and give me a thumbs up or down, but we are working on doing a mastermind course. It's going to be a very exclusive, and if you're interested in something like that, let me know. Was going to make an announcement tonight. We need one more day. Tomorrow, here's my plan for the rest of the week, by the way. Tomorrow night will be a video. Hopefully I'll be able to get on a little bit earlier. And then on Wednesday, I think I'm going to do a live intraday. Maybe we can do some trading. That would be fun, because there's some stuff I want you to say. Yeah, to be honest with you, I'm not sure they've ever done a 0.375. There's no reason to satisfy markets. Fed doesn't care about the markets. I really don't think they do. And if they did, think about this. You would think if the markets were declining, they've been down in a 6-week decline. Oh my gosh, we need to do 50. We're tomorrow we could make an all-time new high. We're 57 on basis of the futures. 57.21 was a high. We traded 56.45, I think, or 40 today. So no reason. Yeah. So Anyway, I'm gonna let you guys know we're working on a whole bunch of stuff. We've been in the background. There's a lot going on right now. But anyway, so the database, not screaming anything's wrong. It would take a big event to cause this thing to go down. If you recall, just going back, what was it, 2 Thursdays ago, where we got that big reversal. All of a sudden, everything's back into running to the upside. Yeah, high dividend stocks are really dogs. They should be called high dog stocks. I'm not big on dividend stocks. I know there's some good plays there, but overall, the most risk that you're ever going to find in a market is in dividend stocks. They carry the most risk. These guys are paying out money. They're buying investors. And I think that, So anyway, let's move on. Let's go through some charts. Let's take a look at the S&P and just see what we got going here. So we'll go right over there right now. Here is the E-mini futures. I mentioned in the Substack, and I'll talk about it right now. We've got 3 new Fibonacci targets to the upside. We're seeing an acceleration here in PPM1. It's right here. Let me draw in a couple things. I just make sure we all have eyes on the same spot. But you can see right here, and this is probably the second circle I drew down here. That's probably this is telling us, what that is telling us is this. The algos are forecasting. You see this upslope in the indicators. Everything where it's dotted is the forecast, so it has not happened. The solid line is where we are, but we're seeing more acceleration right here, and that's where these red dots are forecasting the close one day, that's about 14 days in the future. The next two or three are usually pretty accurate, but we're seeing a lot of upside here. And the other thing here, we've got these fib targets. The minimum fib target, 59.43. That makes us an all-time new high. And we have seen these, I call them somewhat of a phantom type projections here. Let me just draw these in. We saw some here. We didn't quite get up. These forecasts came right into almost exact numbers. And then we have this up here. They could be what I call an island projection. As long as we stay above the 10-period moving average here in this pattern, this is probably at least fib target 1 is going to get hit, which is that 59.43 number. So, and after that though, and this is interesting, because let me just clear this out. What we're seeing after this is the algos are flattening out, and everything as we come into October look a little bit weaker. So I think we're going to get a hesitation before the election. There's a whole lot of stuff. There's a lot of reasons not to get this market too far ahead of itself right now, because the risk, the potential risk of in the markets is way too high. So what the algos, and I think it's even though they're out a little ways and projecting this, I actually think that these numbers, that this stuff that's being forecasted out here is probably accurate, where everything's softening up. It looks like, I'm just going to draw this in, what's happening with the 200 is trying to flatten out a little bit. And my argument has been, and it still is actually, even if we print a new high, I think we get a rejection off of there. So right now is probably not a great time to do that, but we do have these projections. We could easily go to this 59.40, and then right after that we get a failure. If we look at the way that things are set up, I'm just going to draw some lines in here. So these are I'm just going to say between these two lines here is a time zone that we're likely to see some sort of rejection and backfilling, and ultimately we just come into these moving averages again. We've got plenty of support here, but this is forecasting, this bottom indicator is that the 40 SMA is going to start to turn up, which is going to give us that probabilities from that standpoint. So let me, I want to bring up something. I wanted to bring it up the other day, and I put it in Substack. Hey, listen, folks, the Substack is $8 a month, and you can get it for, I think, $6.55 a month or something like that if you get a full year for $80. So you can do that. Let's take a look at, I want to look at something here real quick. I always talk about this angle of attack, and what I want to show you is I actually put it in here. This chart here is basically understanding how to read these PPMs and the WaveTech indicators. Is right now we're seeing these rates at around. You see down at the bottom here is the. Let me draw in a couple things here. Yeah, so this is a typical way the PPMs go. They get up to about 0.50, 0.7. They don't get to a whole number, 1 point something. They get up to that and they flow down. You get trend mode is 0.25 or greater. So it'll double that trend mode, and then the market will roll over on a short-term basis. And so you have the 3 PPMs, and they're going to be in different focus as we go through from the standpoint of what trend level. So when we get into the big trends, the extended trends, that's when we get up here and we get all the way up to like right here. If you can see these arrows, this is where we get into a robust trend, extended trends, and the market keeps going. We got into 1.4 on that 8-day trade that we that we saw when we came down and rejected off of, or bounced off of this level down below and around that 5,400 handle. We got that move out of there. It was pretty spectacular from that standpoint. But this chart I put in the Substack last night, so make sure that you check that out. I just wanted to show that and explain a little bit more. So what the basic theory is behind this is that the angle of the attack of the moving average is like a trend line. So I like moving averages over trend lines because the trend lines are adjusting to market conditions and I don't draw them because I feel like any line I draw on there is subjective. I saw some guy, doing some cup and handle pattern. I was on TradingView at the bottom. They were showing some different types of stuff that folks posted, and it was not a cup and handle. I don't know where they got the idea from, but anyway, it was just really really bad analysis, and it drew all these, and you can make up anything in your mind, and this is what the reason why I got attracted to moving averages and Elliott wave and everything I do is because I found I had to get me out of the way emotionally and I had to have things going. So ultimately what I did was I developed a whole suite of indicators, actually most of them in early mid 80s and then later Fibonacci projection tools and pattern tools back in 92, 94, because I wanted these things just to be done for me so I didn't start making up things in my mind that I wanted to see. And anybody that's traded in the markets for a while know how subjective you can get. So all I've done in my whole life is built, going all the way back to starting in the mid 1980s, is building models that were going to make decisions based on math that I was able to figure out. And that's just made a big difference in walking forward. And that's why I go through the database and I talk about this stuff. I believe in it because I've been using it for a better part of 30 some years right now. So yeah, I think 1998, yeah, we're about 4 years off from being 3 decades that logic has been in place, and it's proven to be very accurate throughout time. So I just want you to see some of these theories so when I'm talking about this stuff that you understand a little bit. Okay, back to the charts. So this is interesting. Let's go over to NASDAQ. NASDAQ is the same acceleration, still posting for higher prices. We've got Fib target 1 here at 21,014. So call it 21,000 is the first target up here, which is basically putting us back at testing the all-time high, which was 20,933. So this is where what's being forecasted right now is just a retest of the high. And, we've got a lot of stuff in play. And I mentioned this yesterday that I thought the tech stocks were a little overplayed, especially the AI stocks and NVIDIA and those type of things. And that this index is very vulnerable to those type of I guess, influences from those stocks. So I don't see the S&P has the possibilities of going up. And I've talked about this on Substack as well. The S&P is actually leading right now. S&P's up 18.1, NASDAQ up 17.2, and the Russell is up 0.88%. So it's not quite 1/3, but it's less than half of the returns. We saw that big move up. There's some things that are setting up there. How am I doing on time? Yeah, I still have about 20 minutes. Yeah, I appreciate that, Tony, on that last comment. Thanks for commenting on that. Yeah, I feel like I get out of control. Yeah, so just real quick, let's do a question or two here, and then we'll go on. But basically, the patterns are the same in both of these. So somebody's asking me, what was the primary inspiration for your models. It was Elliott Wave, actually. Elliott Wave, moving averages, and just the quick and dirty story is that I had a client that was a former professor at University of Michigan, and he was a physicist, and I introduced Bill to his first charts, and then we started studying things, and we were trading and started to figure out moving averages like everybody, and then we started piecing together. WaveTech is actually a combination of using moving averages and using the PPMs to recognize when they were. The whole goal that we were trying to figure out was when was the market trending, when was it non-trending, and then were there patterns that were recognizable. So the basic concept behind everything I've done is based Elliott Wave patterns and these patterns. Now I've evolved out of not having to count and try to validate all of the waves. I've just really, my trading and everything has changed a lot. From a money management standpoint, we program in the models how to handle these longer term trends and stay with them and filter out some of the noise, but be able to stay with the trends. And like I said, I've been making some pretty big breakthroughs, primarily with ChatGPT and some other methodology that I'm using to do two things: is to filter out and to do analysis for what stocks go in portfolios, then also looking at volatility in the individual instruments that I'm doing, and then applying them to our model. So we're actually the plan is to integrate an API to do a lot of this analysis in real time. And so, but the bottom line is that was the basic thing that really drove me to that. So let's take a look at something here. Let's go ahead and let's go over to let's look at the 10-year. And it's interesting because this is the daily. The daily is suggesting tomorrow is the last day that there's going to be downward pressure, and we should start to see, otherwise the bond rally is about to end and it's going to go the other way. So if they were doing 50 basis points, I don't think this chart would look like this. We actually have the potential, and this is a good spot for me to profile this V bottom that I talk about. And sometimes I posted one on Twitter the other day, an hourly chart. It was like across the board, every indicator gave the V bottom at the same time. When you see that, you like back the truck up and you buy everything that you can find. There's an inverted V, but we'll go with I'm just going to map this out very quickly. So this is the V right here. There's a little V here. This one's lagging, but I'm just going to go with this one right here. And this is where it's being forecasted to turn up. And what you see, the red dot forecast is flat and then up. And we should come into this wedge right here. We should start to move into that wedge. Let me try to get a better tool to draw here. So yeah, we have off the market grid should be the bottom end where it starts to turn up, and we'll probably get a little channel up, get into this, right into this 21 day moving average. And that right now is at 3.77. So we should start to see yields actually start to go up. And based on this, it literally is signaling a bottom in yields, and it's starting to turn up. Nothing drastic, but we could go as high as coming into this 40 period moving average I just drew in here, which is at 389. We'll call it 390. So the probabilities are higher for yields at least at the moment. Maybe we get a spike, but they're not going. Yeah, I'll bring up TLT next. So anyway, so that's what I'm seeing here for analysis. It looks like we're extreme. We also have fib targets at 366, 358. We basically, have satisfied the fib targets here as well. So same thing here. This is the inverted V. Okay, so let's draw that in so you can see this. Somebody wanted TLT, so here's TLT. So inverted V is right here, and this one's drastic. And we've got a little mini here. Everything is trying to turn down. So when I draw this in, what we're going to see is this drastic move down in momentum. So maybe somebody made the comment that they're going to rip the market down if they don't get 50. Like I said, I think it's a ridiculous expectation, but if they, I'm not going to be surprised that happens, but the markets may have priced in too much. And that, you know, but this is a big pattern here. This has probabilities, probably an upper 60% of this market turning down, and just looking at where it's likely to go here is here. It's coming down into this level here. So my expectation, I always talk about these wedges. I don't like the draw off the tops and do trend lines, but these moving average wedges, and that what we know is right now is that the pattern is suggesting that momentum's just going to fall off. It doesn't mean it has to, but over the next couple of days, we could see this thing really build from there. So yeah, so as we look at, but that looks like a reasonable expectation for TLT to pull back into these ranges, because I really think that this entire situation here is a bit extended. And if I'm right about what I believe is going to happen as we go forward, we're going to see a little bit of flattening. I don't think there's one last thing I'll mention here. The realities are of what the Fed doesn't want to be seen as being political, even though I think they've shown themselves to be political. I know Powell probably hates Trump. Okay, so who knows what they're likely to do, but I don't think that Powell is now into his legacy. He's, I think, like a year younger than me. The last thing he wants to do is tarnish his career here. He wants to play it out. Guess what? He gets to write books and all kinds of money after his tenure at the Fed. So if he does another 4 years, he's going to write a bunch of books like Greenspan and Bernanke and all of them, right? That's just part of the plan to get paid, you know. So you're making I think they make $1.50, $2.50. I'm not sure what they make, but they don't make a lot of money for this. But you get paid on the back end, right? On the book deals and other stuff, speaking tours and all that. So you got some longevity once you decide to leave. Let me just look. There's a factor here. Yeah, and yeah, so John B, that's what I was talking about. If you go back and watch the replay, if you just came in. Yeah, so let's take a look at this. Thanks for putting that up there, Jason. Let's put TMV. So it looks like an inverse, a Drexon inverse. Yeah, look, you got perfect V bottom. So that's the trade. I think that there's going to be a lot of resistance, so I don't think there's no big plummet. I don't think there's any moonshots here on this. It looks like to me that we do have upward on this thing on the inverse up to mid to late next week or so. I'm just reading some comments here real quick. Yeah, just Chi-Town, Tony. Yeah, it is hysterical that they're asking for 75 basis, worsening labor markets. Um, yeah, I'm not sure where those are. I think the issue that we had on the labor markets, I've managed to get control of myself on Substack because I was really going off on this 818,000 adjustment in the employment numbers. Last year was 174,000. That was big, but 818 is hard to go. Yeah, I know you heard the dog. I was trying to mute him out. So anyway, but yeah, so I think that. Yeah, these guys always want the lower rates, right? So, um, yeah, if the Fed doesn't care, why do they? Because they want to keep control of. So the Fed, okay, this is a really good question. 1329 is they do care, but they want a jawbone. So most of the Fed's action they're ever going to do is going to be what they say in their statements and things that Powell says in his commentary. And he can slant the market sentiment that way without actually taking action. And this is what the Fed always did. Um, and that's exactly what's going on. So, yeah, so we've got about 9 minutes, and I think. Yeah, uh, I think the reason why they're not the senators are not they they are panicking because they want to get reelected and all that. So they're afraid of things here. That's a yeah, 20 years probably not go to 3%. Just looking at a couple comments here, and then we'll do gold and Bitcoin and call it quits for tonight. Okay. Like I said, I'll be on tomorrow night. I'll try to get on a bit earlier, and my goal will be I'll let you know tomorrow night whether I'm going to be live during market hours on Wednesday because we might be able to there might be some crazy trade ideas that comes out. Yeah, I don't think. Yeah, if you're talking about the captain, I like the captain. I don't know him. I've talked to him. I think he was in one of my live rooms once. I like the captain. Yeah, but yeah, there's no reason. I mean, what? Like I said, what possible motivation do they have? The economy's down. The market's at uh, less less than probably 1% off its highs, all-time highs, historical highs, like big numbers. No, there's no need. There's no need. Yeah, I will be on tomorrow, Henry. Definitely will be on. Yeah, just reading some comments here. Yeah, so let's do gold and let's do Bitcoin. We'll call it quits. Uh, got a decent crowd tonight, so appreciate everybody up and being around. So let's go ahead and let's go with gold first. Gold is starting to stall here. This is the daily, but we do have some new fib targets up here, and I started to cover gold in the Substack last night, so let's just do it now. New um, fib targets 2663, 2774, 2762. So definitely still some targets coming out. The only thing that I see, which is interesting, think about this. Let's zero in on this because what did I just say about the interest rates, right? So if we are going to see a little top in the bonds and a, a bottom in yields, check this out. This will make sense. Around the same time here, I'm just going to draw this right here, out a few days as we come in, gold is going to lose its momentum. We're probably going to come back into some of this bear with me, I'm just trying to get the right tool. We're probably going to come back into these moving averages here. That's going to be 25.55 is the 21 and 2500 even. We probably just get into this little wedge shape here off of the moving averages. We probably come back in. The 10-period moving average is very strong right now, so the probabilities is only about 40% for the market to move below that level right now. So as we go forward here into early next week, it's going to be more likely. So if those algorithms are correct and we start to see the interest rates and we do get a peak in the bonds from prices and a bottom in yields, and we start to come back in, then this is probably going to take a little of the gloss off of what we've seen in gold. Let's do real quick. Let's go in and take a look at the weekly chart, just to get a little bigger perspective here. So similar situation, just trying to get a mark here. By the end of the month, we're seeing PPM1 starting to falter a little bit. You could argue for a divergence on the indicator. We didn't. This first strength up into these fib targets were the strongest part of the market. Now we're seeing a new push to new highs, non-confirmed. But you look at all of the, looks like to me, the momentum's going to get lost. The fact that I need to point out something, those of you that have the indicators, is the fact that they're showing declines doesn't mean the market will come back into these moving averages. But I just mentioned on the short term, you got support at 2,500. The big heavy duty support you've got right now 25.12, and then 24.30 is going to be where the big support is. That would be like, back the truck up if you get there. I think you see this really come into a pattern. If we do get back below the 10-week, then we're going to set up a big consolidation. And basically the way the market's been working for a while is new highs consolidate, new highs consolidate. And if we try to put like a wave count on this, it's pretty sloppy. You could argue that this was maybe a top of wave 3, and we're going to get a big 4 up here, and then there's another. They all goes as we look out, and this is kind of, well, I've told you this. I like to put these out a little ways to see what is being projected. This is using some machine learning off auto regression math. It's using 150-day coefficient or look back period and doing it in increments of 3. So it's grouping these walking forward groups at 3 and 150 bars. And so it's forecasting out into the future what it might look like. And those of you had it, some of this stuff is like amazing how accurate it is. So I like to just put it out there. And then I always ask myself the reverse fundamental concept, which is, if that's going to happen, what's it going to look like? So if interest rates are going to, if I'm right, and they do 0.25, in November they do nothing, and December the Fed lowers 25, that's going to set a perfect tone for gold to go into a bit of a sideways pattern. There is, as I mentioned a minute ago, on the daily charts, I'm just going to go back to that, and then we'll move on to Bitcoin. But there are some upward Fibonacci targets here, which are suggesting a move. Let me just get that. Like I said, 2663, 2774. We'll just stick with those two. But we're not getting confirmation that there's an acceleration and trend coming in from the standpoint of the algos are not confirming that there's a surge to hit these fibs right now. And we'll see what happens. If we trade down, we have to trade down. I'm just getting a number for you real quick. We're going to have to trade below that. Looks like 25.40 If we go below that, the fibs will stop calculating and we'll end up in that pattern we're talking about. Okay, let's do Bitcoin. Yeah, I just got. And, and listen, I just want to say that you really should get the Substack. So it's kendallreport.substack.com. And I put a lot of effort into that and writing it every night. Sometimes I'm a bit of a vampire sometimes. And like I said, I think it was 4,600 words. Sometimes I get a little carried away. But but just going in here on one of the things I've been talking about on Bitcoin is we're really just locked in this pattern here. And we did see a little bit of downside. We're coming back into these moving averages. We look at the algos. They're also PPM2. This is the red one right here where you see my cursor. That is suggesting that we have potential a little more stability as we come into the next couple of weeks. But here's the deal with Bitcoin. I think it is absolutely locked in a range. The upper 200 is going to be the top end around 64,000, and this lower pivot that's here right now, which is around 50, we'll call it 50, 54.5. We're going to stay in this range, and I've said this before. I think the other night when I covered this is really what the unfortunate part for the Bitcoin community and for Bitcoin long-term holders. They let the bad guys in. They let the ETFs in. And now there's more money to be made off of arbitrage than there is in owning Bitcoin. So that's why you get into these ranges. There's going to have to be, I don't know what's going to cause Bitcoin to get traction and go into all-time new highs. I won't do a long-term look on this, but as we come into, as we come into the 1st of October, I will do a big deep dive on the longer term from that standpoint. But we're probably back into range here. Let me bring the algos up. Yeah, algos are just suggesting no big downdraft, no big updraft, just sideways chop. There are some Fibonacci targets above here. They are, I mentioned these in last night's Substack. 61 500, I'm rounding numbers, 64 950, 67 051. That's the green dots that you see just above here. Yeah, okay, folks. I'm just going to read a couple of comments here. Yeah, so yeah, I'm not sure. I'm trying to get Noah's comment here. Are you able to predict anything reliably, or are you just like, yeah, so yeah, I've predicted things pretty accurately. Those of you might remember before the NVIDIA split, I predicted exactly where it went to. In the so what does that move to? Yeah, so we're going to have to deal with that rollover pretty soon here. I hate rollovers, and I'm not sure when that switch. I think, technically speaking, I think it's not this week, but the next week we're going to have to roll over to all the Z contracts. We're going to have all these premiums to deal with. So I've always looked at it this way, just to comment on this from that standpoint, is that the probably I just use the pricing. I just kind of go with the flow. What I don't like is the rollover methodology that I have that is used on TradingView is a little bad. So what I'll do is I'm going to probably stick with the the front end with the U's with the Septembers until we see some stability. They're going to roll over the second that the volume, I think, on the front contract is higher than the U's, and they'll roll it over. And yeah, so let's do this. I'll be on tomorrow night. Maybe we'll touch on some stocks tomorrow night, and we'll get into some of those things. Yeah, everybody else, I'm showing great volume on this thing. It's pegging out on going into YouTube. I've seen that before. Anybody else have any issues on volume? Just so if there is an issue there, I need to crank it up. I mean, I literally pretty cranked out. Hey, thanks, River. Appreciate it. So sound. I know there's a bit of a lag. Yeah, Doggy did a good job tonight. Absolutely. I miss being at my studio, but it just doesn't work with what's going in life right now. Yeah, okay. Yeah, I think, I'm not sure, some folks just have some issues with the sound, yeah. And I've actually got a booster. I'm going to try to get it up for tomorrow. Okay, thanks. That's it, folks. It's a little bit after the hour, so I will call it quits here. Be on tomorrow night. I'll try to, what I'm going to shoot for is 8 p.m. The nice thing about doing it a little bit later is that I can get the look at the database, which is quite helpful, especially looking at, on a day-to-day basis. That's usually, I think it finishes at like 5:20. So that will be, yeah. Yeah, we went through, yeah, so. What kind of dog? It's a little Papillon. It's the wife's dog. Our German Shepherd passed away a couple of years ago. So, yeah. Animals are tough. You get too close to them, you know? So, yeah. So, yeah, River, I'm not sure what's going on with the volume for you. All right, that's it. Appreciate everybody watching, hanging out. Make sure you hit the like button, subscribe, all that good stuff. We'll talk to you tomorrow. Like I said, I'm going to shoot for 8 o'clock. I'll throw something out on Twitter, which is Portfolio Expert, no E in expert, just Portfolio with the X, PERT, P-E-R-T, and that'll get you there, and you can follow me there. All right, folks, have a great evening.